Hello, hello. Good morning, friends. Good afternoon to those who it is afternoon for. How you doing? Mic check, 1 2 1 2. Chat is popping. Let me know if you guys can hear me. There we go. I had a brief delay in the chat. I was sitting here just watching. The chat wasn't moving. Now it seems to be moving. Let's go. Hello, hello. Welcome, friends, to Alpha Beta Soup. I'm TXMC. Let's get to it. Great to see everybody. It is February 1st, 2024. I think it's Thursday. Is it Thursday? It's Thursday, February 1st, 2024. Great to see everyone. Smash that like button if you haven't already, but I see a few of you have. Oh, great to see everybody. Lots of activity in the chat before I even got here. Welcome to a couple new members of the channel, a couple of new friends who can join the member stream that we will be having today after the public broadcast. If your name is green in the chat because you either became a member or were gifted a membership, then as soon as we're done with this public stream today, we're going to do a member stream right after, about maybe 30 minutes after. We'll take a little bathroom and refreshment break, and then we'll have a little private stream where we can chit-chat and shoot the shit a little bit. Really looking forward to that. I am TXMC. This is my live stream. Welcome. None of this is financial advice. This is just the research and opinions of a singular man on the internet that you are following because you find me entertaining. Do not take anything I say as investment advice. Take it all with a grain of salt. These are just my views. What we will do today, we'll talk about the markets a bit, but what I really want to do, I want to talk about the FOMC from yesterday, my reaction to watching it, what I thought going in and what we think coming out of it, anything related to that. And then there's a couple other topics I'll touch on, some things related to the banking concerns from yesterday and how some of that is related to real estate exposure. We'll touch on some of that later because that's a topic we've been following quite a bit here on the channel as it relates to the massive difference between the rate cuts the market actually needs to afford the current cost of capital and how many rate cuts they might actually get from the Fed. The difference there is massive, and I think that there is a huge repricing event ahead of us in 2024 and into 2025. That's where I think we're going. So, well, we can see gold is absolutely ripping right now. Holy crap. I haven't been looking at the charts that closely this morning as I have been getting my thoughts together for the stream, looking at the FOMC yesterday. I made some notes about just a few things that I heard in the press conference that I'll go through with you guys. And so I haven't really been watching this that closely. Yesterday, the markets dumped heavily before we got to FOMC because there was a news story that New York Community Bancorp, which is a regional bank, had suddenly surprised investors with a massive cut to their dividend and an explosion in their provisional loan losses, their provisions they make for loan losses. And it got people really scared that we were about to see chapter 2 of banking stress. So their stock plummeted like 20% in pre-market, and it seemed to rattle investors in the morning before we ever got to the FOMC. Like I said, we'll touch on some of that a bit, but today, as I'm just sitting here and I'm looking at the market, like here, here's the S&P, here is what it did yesterday, and we're now bouncing back. So there's a bit of reflexivity happening here, a bit of bounce just due to physics, just due to the sharp move we had yesterday, and a lack of real continuation in the news cycle today to force it to keep going lower. So that's kind of that's my interpretation of this here. I'm not going to get into too heavy on the TA right now on where equities and things are, because frankly, I think that this is a moment to be a wait and see kind of person. I don't think that this is a place where you can make large directional calls about what's about to happen here. We're right above the prior all-time high on the S&P, on the NASDAQ, slightly more than that, on the Dow Jones, slightly more than that. But with everything that's going on, with the concerns that I have for this year, and the delay in those concerns actually manifesting in a market outcome, there is a delay there. It makes it really hard to get a read on this. You know, I might have a general bearish tilt about the economy, but that doesn't mean that I realistically think, oh, well, that's the top, let's just go straight down. Nothing happens like that. So it could very well go higher. It could chop back down here, reclaim, get back above, keep going higher, and then we have something later this year. I don't know. I think it's a wait and see kind of moment currently for equities, because they haven't given a real clear breakdown, even though we've now broken up. The breakdown hasn't really been clear. The daily candle looked kind of ugly, like on the NASDAQ. Like on the NASDAQ yesterday. A daily candle looked pretty ugly. Some of the individual names looked pretty ugly, but this didn't go down that far. You know, this was only like a 1.5% day, I think. So, you know, it looks bad, but it really hasn't gone anywhere yet. So we're not going to jump to conclusions about equities. But let's talk FOMC. Let's put some of this aside. Maybe we'll get more into this as we go through. I want to stick to the big event of yesterday, which was the Federal Reserve and their policy meeting. So everyone knows by now that they kept rates where they were. And one of the things that I find interesting, one of the first things that I look at every time we have an FOMC is, what did they change in their statement? Now, there's a lot of people that find following Fed Watch and Fed Speak stuff boring, or they make fun of it because they don't see the point or whatever. And if you lean into that camp, well, that's fine. I find it interesting. These are the people who control the most impactful, the biggest monetary levers on planet Earth. The things that they say move trillion-dollar markets. So it matters what they say. And they put a lot of thought, the Fed as an institution, particularly under Jerome Powell and in the last couple of Fed chairs that we've had, Yellen and Greenspan before him. We're in an era where Fed language is one of their most powerful tools. If you think back to 2022, most of the market's moves were around things Jerome Powell said they were going to do, not the actual changes to interest rates. There were very few surprises on FOMC days over the last 2 years. Most of the time, the market knew what was going to happen before the meeting started, because the Fed goes through great lengths to communicate what they're thinking, or at least to try to steer the market in the direction they want it to go. It doesn't really matter how truthful you think they are. It doesn't matter if you think what they say will actually come true at the very end of it, months or years from now. Those things matter less than the intent behind them saying it now, here, today, with the information that we have. So their language matters a lot. Their forward guidance matters a lot. And the things they choose to say or not say have a certain amount of signal to them if you pay attention. This is their policy statement. From meeting to meeting, they make small adjustments to it. It's very deliberate. And so when they remove a word and they replace it with another word, they had a conversation about that. It doesn't happen casually. So that's why we kind of go through it with a bit of a comb. And couple of the things that I noticed in reading this. The first one, which is pretty funny if you're a Fed watcher, is this line right here. This one that's all crossed out that says the U.S. banking system is sound and resilient. They crossed this whole paragraph out. It has some other stuff about tighter financial conditions weighing on economic activity, etc. But the first line, the U.S. banking system is sound and resilient. They made sure to take this out because just about 6 hours before the meeting yesterday, New York City Bank, Community Bancorp, crashed 20% over banking fears, right? Like we were just talking about that because this chart did this yesterday and it is a bank. And so right before the meeting, they removed the statement that says the banking system is sound and resilient. I find that fucking hilarious. I don't know. A couple of other things I noticed. They removed here in another one of the changes, they removed the only mention in this whole statement of the possibility of additional policy firming. So they've kept this language in the past many statements, just like they had the banking system is sound and resilient. They had that in the last several statements. But they've been playing around with the wording on this part right here about how data as it comes in will determine the extent of whatever additional policy firming is appropriate, and then they changed that to may be appropriate, signaling that rather than expecting to hike again in the future, now we're not really sure that we'll have to hike again in the future. That's what additional firming may be appropriate meant. Well, now they took all of that out. There's not any mention anymore of potential additional policy firming. So that is a clear signal that they've reached peak interest rates as far as they are concerned. Barring a surprise, barring something changing, the direction of inflation is such that they're on the right trajectory as far as they see it, and they don't think they will have to raise rates again. Now, that they will raise rates again if inflation spikes heavily or it starts a new uptrend. They will respond. But barring that, they appear to believe that they're now at peak rates. And I think that's pretty interesting. In the press conference, those are the main two takeaways from the statement here. In the press conference itself, I watched the whole thing. I always watch them. There were a few comments that I made some notes about, things that Powell said that I want to highlight here. So he mentions, as we said here, they removed the possibility of additional policy firming, right? Powell used the words, I'm paraphrasing, we are at peak rate. I can't remember the exact sentence he used, but it was something along the lines of we are at peak interest rates. And then he said inflation's on the right path, but they need to see more data, not just better data, not like inflation's currently at 2%, it needs to be at 1%. They just need more data points going in the direction things are currently going in. If we look at CPI, this is CPI, it's a bunch of different rates of change of CPI. The black one is the year over year number. It's the number that we always hear, 3.4%. That's current CPI. On a 6-month basis, CPI yearly is 1.1%, considerably below the 3.4. On a 3-month basis, CPI is negative. So for the last 2-3 months, CPI has actually come down, like the index of prices has come down overall. And that's been led by goods deflation. So if we go zoom in, here's the index. This is the index that produces the year over year inflation number. You can see it peaked here in September, and look, it's gone down. So we've had 1, 2, 3 months of falling prices on the headline CPI. And that is largely led by goods prices, falling energy prices, and some falling food in certain food categories. Those are falling as well. So according to the Fed, things are going according to plan. Things are going in the right path, but they need more data points down in this region. I don't think that they need to see year over year CPI print a 1 handle necessarily, but according to them, they're going to want to see several more months of prints in this neighborhood and things trending this direction before they begin the process of wanting to dial back policy. He talked a lot in the press conference about policy easing being a process. It's not something that they just flip from tightening to easing, tightening to easing, tightening to easing. It's something that they're very deliberate about. They wait for data to come in. They talk about if they're going to start. They talk about the pace they think that it will play out at. And then they very methodically work through that process. Unless something forces them to act more quickly, they're a very slow-moving institution. And we have so far about half a year of data in the pipe that says that inflation has come back down to where it needs to be on a rate of change basis, on a headline basis. Now, there's parts of CPI that aren't there yet. The core figure is still quite elevated. It's still up at 3.9 year over year core. That's minus food and energy. There are certain measures of that are still elevated. There's little pieces inside of it, certain sectors that have remained kind of resilient, that haven't rolled over in rate of change terms. But we've got half a year or so right here of data that looks pretty good. But for them to say we don't think we have the confidence yet to move tells me two things. One, it tells me that 6 months of data is not enough. So I would assume they want 9 or 12 months of data, which might mean that we wait until summer before we really start to see them move. That's one possibility. I lost my train of thought. That was the main thing. The main thing is that it seems like we have 6 months of data, and they probably need another maybe 6 months of data to really begin to move on some of these things. He talked a bit about how committee members largely favor cuts this year. Like the vast majority of Fed members favor doing some amount of interest rate cuts this year in 2024, but they differ on the amount of them. When you look at the projection from from December, when they gave the last summary of economic projections, which we looked at here on the channel, they showed about 3 cuts this year, roughly 75 basis points of cuts, which is 3 25 pip cuts. But as he said, they need a lot more data before they even begin that process. And once they begin that process, it will be slow moving. They're going to cut once, and then they're going to look at the data, then they're going to cut again maybe after a meeting or 2 meetings go by. They'll look at some more data. It's not going to come in massive chunks, I don't believe. I think they will be much more methodical about it. And when you look at some of the individual Fed governors, things they've said, like Raphael Bostic and Mary Daly and stuff, they've suggested that maybe June is the first time we get a cut. Maybe it's even later in the year than that. So there's a wide variety of opinions, but they generally congeal around cuts starting later. And Powell was directly asked about this. He was directly asked in yesterday's meeting, do you think that you will begin cuts in March? You've already gotten all this data. Inflation has been holding around 3% for the last half a year. Some of the other measures are coming down. And on like we said, on a 3-month and 6-month basis, it looks really good. It's well below target. And his words were, I don't think it's likely the committee will reach a level of confidence by March that lets us start the process of dialing back restrictive policy. So he doesn't think that by the time we get to March, there will have been enough impetus to force them to do a total change of policy. Right now they're on hold, right? They've done a tightening. We are stuck at that tightening. They're not expecting to do more. As we just said, there's no more additional policy firming. However, that process of coming back down is one that they don't take lightly. What did he call it? He said something. He said, it is a highly consequential decision to begin the process of dialing back on policy restriction. We don't want to put a number on how many months of data is needed to give us that confidence. He said, it's a highly consequential decision. So it's something they don't want to just be flippant about, and which is a weird dichotomy, because when we watched him in December at the last FOMC, he was outright giddy. Like, he was excited about how good the data looked. And since then, we've seen a massive easing of financial conditions, which is something we talked about here on the channel quite a bit. We talked about real interest rates falling a lot since October, November, right? This was Halloween right here. Real rates on a 10-year basis were 2.5. Now they're at 1.6. Real rates have fallen 90 basis points in the last couple of months because the Fed and the Treasury have signaled to the market that we're near the end of this tightening process. And the market has jumped on that and has started to ease things themselves. And that's kind of interesting because in the press conference, someone asked Jerome Powell, if you keep interest rates where they are, right? If you have, let me get my drawing tool so I can use this as a frame of reference. So if you have hide all. Can we hide everything? Sorry guys, I'm just going to try to hide this so I can show you. Yeah. So there's two things that go into the real rate, right? There's the policy rate and there's inflation. And these two things combined make the real interest rate. So if inflation is at 2% and interest rates are at 5%, then real rates are at 7%. Wait, I'm sorry. Real rates are at 3%. I'm sorry. Sorry, there's noise in the background here. I got a little distracted. What I was trying to say was, someone asked Jerome Powell, if you keep interest rates where they are, if you keep them at 5.5%, but inflation, which real interest rates are an adjustment to, if inflation starts to fall, then real interest rates will be going higher because the adjustment to the nominal rate that produces the real rate, because real rates are interest rates minus inflation or inflation expectations. So if if interest rates are 5% and inflation is 3%, then real rates are 2. The interest rate is 2 points above what the inflation rate is. If the inflation rate is falling, then the real rate is technically going higher, right? It's becoming more restrictive. That was what someone asked him about. Sorry, my example here is kind of sloppy. Someone asked him, well, if inflation is coming down, but you haven't changed the rates, aren't you making your policy more tight by doing that? And shouldn't you start lowering rates over time while inflation comes down so that inflation is falling and interest rates are falling so that the real rate stays steady? And he said, that's not really the way it works. We can't look at the market-based assumption of forward real interest rates and walk down the policy rate. We can't do that. It doesn't work that way. That's what it might sound good on FinTwit. This is not Powell saying that. It might sound good on FinTwit that is what they do. But Powell's own words are that isn't really the way it works. Inflation can be falling, but they're not just going to walk rates down perfectly in line with inflation and keep everything at an ideal equilibrium, because there are other reflexive forces in the economy that work, and inflation itself is a year behind, right? The measures of it. So it's just not really something that they can do in that way. It doesn't work that elegantly. And so I don't think they're really paying attention to the fact that real rates have come down, and so they need to cut to keep in line with those real rates. But what they can see broadly is a loosening of financial conditions. The real rates have come down because inflation expectations have been stable and yields have been falling, just absolutely plummeting. At the same time that we've had massive bids, right? So bids in bonds and bids in equities. The market itself has loosened. And I think that also paradoxically reduces the odds that they will cut because the market's doing it for them. The market is lowering its expectations of inflation. The yields are coming down. The 10-year is being bid down. And GDP was 2.5% last year. The whole year we grew at 2.5% in real terms, which is actually really good. So the market is, and every question yesterday was about interest rate cuts. Literally every question, with the exception of one person that asked about the balance sheet. Everybody else asked Jerome Powell what he has to see to start cutting. And really the only thing that he could agree would force him to move more quickly is if employment began to slide. And we know that employment has not been sliding. If anything, it's still at all-time lows, or secular lows. And so if this began to pick up more than it is now, it's currently at 3.7, which is way down here. It's a level we haven't seen since the late 60s. It hasn't hung out at this low of a level since the 1960s, since 20 years before I was born. So this is a very weird time period. This is very anomalous for us to have this. And it's part of the reason why the Fed is close to declaring victory. It's because they haven't seen the headline unemployment rate move higher. And the market's just constantly trying to front run this policy reversal. And by constantly trying to front run the reversal, they paradoxically push the reversal further out into the future because the economy is roaring and markets are roaring and labor and financial conditions are easing. Long end yields have fallen. The market is being bid. Bonds are being bid across the curve. So it's a weird kind of time here. You know, the prior response function of the Fed is hard to apply to today's markets because in the past, every time they've eased off on policy, it's been because they were forced to. And now we're in a situation where this year they may actually start easing just out of pragmatism. It's yet to be seen how that will play out and what that looks like. But we've talked about on the channel here quite a bit about how this slow playing of rate cuts is probably not going to play into the hands of the market the way that they expect. And it's because of the huge difference between the cost of current debts and the cost of what they will be if people pay today's interest rates. There's a lot of debt that was built up before the Fed started hiking. And for anyone to access new credit today, they have to pay current interest rates. And for many borrowers, that is 3, 4, 5% higher than what they were paying before. And in some cases, the property that they need to use as collateral to access that credit has fallen in value. So not only are the rates higher, but the collateral is worth less. And so borrowers are in a really tight place, and they have been delaying paying the current rate of interest. We've looked at this a lot on the channel here about how businesses have not refinanced, commercial property hasn't yet refinanced. There's been some distressed sales, but banks have been really just trying to avoid that as much as possible. Households don't want to sell any of their existing homes. Consumer credit has slowed down. People don't want to pay current interest rates. And everyone is hoping that the rates will come down a lot before they have to do that. And so now we're in a game of chicken. Right now, we're in a game of chicken, and it's between the Fed slow walking cuts with a really strong economy and the market going, please fucking cut. Like real soon, please fucking cut. And it's just not coming. Let me go look. Let me go find a notification that I saw yesterday. Here, Preston shared one of my tweets. Here it is. It's this chart, right? Everyone's debt is down here. Rates are currently up here. The Fed is playing around with maybe cutting like down to here this year. Here? This is where rates would be? Like, this is what the Fed's playing around with. Maybe we do 75 basis points of cuts. 75 basis points would put us right here. This is the delta. Like, this distance right here is a huge chasm. This represents increased cost of capital. And if your property, your assets are not worth what they were worth back here, and you are trying to access credit today with those same assets, you're in a world of hurt. You are going to have to sell some things to get liquidity. And that means price discovery. I think some of that's coming this year. We'll touch on a little bit more of that maybe in just a bit. Look at some news articles together, some things related to this topic. I have a couple more notes on FOMC. Let me look over here. I have them all written down on my other screen. One thing Powell said, recent disinflation has been from goods prices coming down. That's what we looked at with the CPI coming down, largely led by food and energy prices. And he says, if and when that levels out, which it probably will. So if the rate of change of energy and food prices falling, if that starts to slow, right? Like right now, food and energy prices, I'm exaggerating, but they're coming down. And so that's lowering the rate of all inflation broadly. But what if they just start to level out? And so that the downward pressure that they're placing on CPI starts to ebb and it becomes a neutral factor rather than a deflationary factor. What does the rate of change of CPI look like at that point? Does it spike back up? Does it stay at 3%? Does it start accelerating again simply because it lost its downward momentum? Those are things we don't know. That's what Powell acknowledged yesterday, and it's part of the reason why they still need more data points before they start this whole train going the other way. Because they can see that the market is front-running the reversal. They get the same data that we do. They can see it. They can see that financial conditions have eased. And if you look at Fed rate cut probabilities, which we've looked at here, this is the table of what the market thinks will happen to Fed cuts over the next FOMC meetings through the rest of the year. They still give basically a coin flip every meeting to an interest rate cut. Powell said, hold on, let me take a sip of water. Yesterday, Powell said explicitly, I don't think the committee will be confident enough by March to start cutting. That is not our base case. He literally said it's not our base case that we will start cutting in March. I don't think we will have enough data to give us that kind of confidence. And what happened? The market still priced a 55% chance. Or what is this? A 45% chance of the Fed delivering a cut. Sorry, I read that backwards. They gave a slight advantage to the Fed staying put, but there's still a 44% chance that they will cut in 2 months, even though Powell basically just said, we aren't planning to do that. The market doesn't believe him. It thinks that they're going to cut anyways. And by March, it's probably for sure going to happen. 55% chance that by March we get that elusive cut. This is really interesting to me. These probabilities have not really moved at all since yesterday, except for right here, these flipped. The fact that this is still basically a coin flip for a interest rate cut in 2 months when Powell threw explicit cold water on that yesterday, it shows you the behavior that we are dealing with. When you have real rates fall 90 basis points in a single quarter, when the Fed changed absolutely nothing about policy, like that is the market. Here's policy. Policy hasn't moved. Here's the Fed funds rate. It has not moved. And real rates have plummeted. This is the easing of financial conditions. This right here is the bet on a return to normal. And I think that it's the last vestiges of this era that we left behind. We had this QE zero interest rate regime for such a long time. And it embedded behaviors into the psyche of investors where they expect risk to be beneficial. They expect rates to trend downwards. They expect the Fed to tend towards soft cushioning of all financial markets. All of those behaviors are being challenged in this current regime to one extent or another. Not in full. We haven't had a full shattering of people's beliefs around the Fed put, but it's being challenged. And it will be challenged this year because of this delta. Because the Fed is telling you, yeah, we might slow walk some cuts and maybe we end up like right here. The market is saying, well, you guys are going to cut this much, which is twice as much as they say. And even this twice as much, which is an aggressive expectation, is a massive delta from financing costs being what they were before. And this is unresolved, and this will be resolved this year. I strongly believe that. And as long as the economy stays overheated and it doesn't really show the kind of cracks that we've been thinking we would see at some point in time, then that brings that reckoning closer, and it adds energy to the potential violence of it. And so that's kind of how I'm seeing this dynamic right now. When he was asked yesterday, when Powell was asked directly, do you think that a soft landing has been achieved? Soft landing meaning we have cooled the economy off enough to defeat inflation without creating a recession and high unemployment. He said, we're not ready to declare that. We still have a ways to go. Those were his words. It was very clear to me yesterday, A, that the Fed is done hiking as long as the market cooperates and the economy cooperates. It was also clear that they aren't ready to start easing and that they need more information. Some of them may be ready to, but as a group, as a policy-making body, they are not ready to do that. He explicitly said, and remember, for the last 2 years, they have gone out of their way to tell the market what they wanted to do. Remember that. And then yesterday he said, we don't think we're going to cut in March. That's not the base case. I don't think we're going to have enough data to be confident by then. And this is after 6 months of data where CPI has just been stuck at 3%, where on a 6-month and 3-month basis, it continues to fall, suggesting that this headline data will go lower soon. And even with all of that, they don't feel confident that in 2 months they're going to hike. But the market said, fuck you. Yeah, you are. You probably are. We maybe believe you a little bit. We believe you maybe 5-10%, but we still think you're going to hike. We're going to give it pretty good odds. And by May, we say you will have cut. It's fascinating. It's fascinating. And I think that a lot of the behavior of behind what drives expectations is people projecting the outcome that they need or want to happen rather than what they think is likely to happen. The game that we are all playing, the game is not what do you think is going to happen. That's not the game. That's not the game. The game is guess what the Fed is going to do. Doesn't matter what you think they should do. It doesn't matter what the data says the Fed is supposed to do. You need to guess what they are going to do. And for the last 2 years, they have explicitly said what they are going to do, and they have done those things. When we were in early 2022, the Fed said, we're going to hike, and we're going to hike a lot. The market said, no, you're not. We don't believe you. If you start hiking interest rates, the economy is going to go off a cliff. And what did they do? They hiked 550 basis points in 18 months. Then we get to 2024, late 2023. What happens? That same market that was talking about the Fed being unable to hike, and then the Fed did hike. Not only the Fed, every central bank hiked. The market was dead wrong about that. It was wrong, hilariously wrong, about hikes to the upside. And now it's calling for massive cuts. The same market. And the Fed is saying, that's not what we're planning to do. Who do you think we should listen to right now based on recent history? I would say we should listen to the Fed. They've gone out of their way to tell us what they want to do. They're being explicit. The market is still saying, no, you're wrong. You're going to deliver massive cuts this year, but we're still going to project 11% EPS growth on the S&P. We're still going to project 3% GDP. We're still going to project unemployment below 4%, but you're going to cut 200 basis points? The market was so wrong about hikes. Why can't they be wrong about cuts? They can be, and they likely will be. This is the kind of rational thought process that a person in my view, my opinion, that a person needs to have in this market. And what I see continually is people going off their gut feel, people getting emotional, feeding off of each other's analysis and becoming even more hyperbolic, and projecting what they would prefer to happen and trying to make the data fit why that's a good outcome. It's the return to normal trade. The return to normal trade is global consensus. We've looked at this, haven't we? The market expected this in 2023 in terms of hikes. They were all wrong very badly. Ignore Japan, but everybody else was wrong. And now they're all saying we're going to get gigantic cuts. And the Fed literally said, I don't think so, guys. I mean, not where we're standing right now. Some shit would really have to go wrong for them to cut 110 basis points just right off the jump. That's 4 cuts of 25 bips, maybe 5 cuts of 25 bips in a single year. It's not impossible. I just want to paint a picture for you guys that contextualizes this cycle. And when we began the cycle, no one believed we would get where we are, including myself. I was one of the people saying, you know what? I don't know if they're going to get past 2% or 3%. That would be difficult for me to see. Well, they did it anyway. They plowed right through there because they can make the interest rate whatever they want. They could make the rate 30%. There's consequences, but there's nothing to stop them from doing it. They could just go raise rates. And they walked them all the way up to 550. I think that all of this speaks to the same behavior. The market not believing Fed cuts, the market being dead wrong about hikes on the upside and now likely wrong about cuts to the downside. And then the delta between financing costs for existing debts and financing costs for new capital or new credit that is accessed, and how no one wants to refinance. No one wants to roll their debts. Everyone's trying to kick the can in the most creative ways possible to hope for savior from the Federal Reserve and the Fed's telling you guys, I don't see this coming the way that you think. And so in my mind, that opens up the door for 2024 to at some point have a dramatic recalibration between expectations and reality, because expectations are untethered right now. Not inflation expectations. Those are well anchored. Cut expectations are untethered. And the Fed is telling you that our policy works around anchoring inflation and anchoring inflation expectations. And much more time needs to go by for them to determine if anchoring has happened. Powell even said in the press conference, they don't want CPI to just come down and bounce off of 2%, just come down and just, let's say this is 2% inflation, 2% right here, and here's CPI. They don't want CPI to just come down and go, boop, 2%, yay, victory, let's thumbs up. That's supposed to be a thumbs up. Yay, victory, we bounced off 2%. No, they want inflation to stay at 2%. That takes time, and that takes data compiling over time for you to see that happening. Right now, we're still doing this. We're still decelerating down to 2%. Then we need to hit it and it needs to become the mean, 2%. It needs to not be resistance becomes support. We don't need a breakout. So that's kind of my thoughts on that. I'm going to stop here. I'm going to take a sip of water. I'll catch back up on the chat with you guys. Make sure you smash that like button. Let me check out what's going on in the chat. I really appreciate all you guys being here. Thanks so much. I know I say that every week, but I really do mean it. All 212 of you that are watching right now, thank you so much. Make sure you hit that like button. I hope I see 200 likes. Abeja, welcome. H, welcome. XP Market, join the Founders Club. Bro. Big spender. Welcome, friend. Eric Martinson gifting a membership, gifting 2 memberships. David Kyra also gifting the OGs. Really appreciate you guys and your generosity. Thank you, XP Market, for joining the Founders Club and showing a little extra love to your boy. Thank you so much. And H and Abeja, welcome. All of you who were gifted and acquired memberships, you can join the private stream that we'll do right after this. Let me scroll back. Let me catch up with any questions you guys might have had for me while I was doing my rant. Glenn, before I even got in here this morning, Glenn said, greatly enjoying your weekly episodes. If we get a hard landing, what do you think Bitcoin will do? Will we still get an all-time high in 2025? Well, 2025 is next year. That's hard to say. My bias for Bitcoin all along has been predicated on mostly the fact that I think we're near the end of the economic cycle. One of my good friends has a technical thesis that aligns with my economic thesis. And, he's bearish on Bitcoin's price. And I mentioned some of that last week in a little rant I did at the end of my stream. And I even had people commenting and telling me they were unsubscribing with how emotional I got last week. I don't know if some of you guys heard that. It was the very end of last week's stream, like the last 15 minutes of last week's stream. I described how BCB, Blockchain Backer, my friend, how his technical thesis and my economic thesis have lined up over the last 2 years, and how it's hard for me to look away from those two things. And I described his part of it because I'm not a technical wizard like him, so I didn't want to try to do justice to it and explain all the ins and outs of his thesis. I basically just drew a squiggle on here. And I was like, this is kind of what he was thinking. That doesn't do justice to the amount of research and analysis that he has put into his thesis, right? His technical thesis. But people who heard me last week just took everything that I have said and condensed it down to me just thinking that some dude that I know who drew a squiggle on a chart is going to come true. And so I've based all of my analysis on that. And like 5 or 6 people commented and said, I'm unsubscribing, which kind of blew my mind. That had never happened before. But what I said last week was that I have a friend whose technical abilities are beyond mine in terms of analyzing price charts, and he has a bearish technical thesis. I have a bearish economic thesis, and they are aligning at the same time, which gives me high confidence about it being true. And when I analyze negative economic outcomes, those are recessions and depressions, when I look at those things, there is a consistent pattern in markets. And that pattern is that the stock market takes out very old lows. The drawdowns are all over the place. The drawdowns are anywhere from 20% to 80%. They're all over the place. There's a couple of 50% drawdowns in there, depending on the index that you're looking at and the era. But what's more consistent than the drawdown in price and making a new low for the cycle is the amount of time that is erased by the market when it hits the low of the recession. And it's this chart, which I haven't shown you guys in a while, but is how we came to those conclusions. What this shows is the change in the stock market. In every recession, going back to 1937, I took off the Great Depression on here because it breaks my whole chart. I'm not even going to show it to you guys. It's so hideous. But everything since 1937 onward, whenever we've had a recession, how low in the past did the market dip down and take out old price action, right? Let me give you an example before I show you the data itself. And I answer your question. Glenn, I'm working on answering your question. It just takes me a while. Here is the Great Recession, right? This is the Great Financial Crisis. The bottom of the Great Financial Crisis took out all this price action, right? It took out all this price action. And it touched a low. Oh my God. And it touched a low back here in 1996, 12 years prior. So the drawdown was 50%, but the amount of time that was erased by the drop, the amount of previous price action that was nullified, it took out a 12-year low. And that is represented over here. This is the Great Financial Crisis. See, it took out a 12.5-year low. The x-axis is the amount of years of price action erased by the low of the recession. The Great Financial Crisis was 12.5. The 1973, 74, 75 market took out an 11-year low. The 1968 market took out a 6.5-year low. And over here, you can see a bunch of them clustered. You see that? This cluster is between 2 and 3 years. And so, on average, it's very typical in a recession for us to take out 2-year-old lows or longer. The current low for the S&P was in October of 2022. So it's very possible that we could absolutely take this low out in a recession because it wasn't even 2 years ago. It was barely a year ago. It was a year and 3 months ago, 4 months. So could we take this low out? Absolutely. That's on the short end of the distribution, right? We've got a couple that were shorter than that, but most of them are after 2 years. Several of them are after 3 years. So this is really the sweet spot right here for 2 to 3.5 years of price action. Well, from our low here, that would mean our window of time like goes where is it? Where's 2 years? October 2024 into 2.5 years. That's still like right here. So like we've got a long way to go just to hit the front end of the distribution for when a recession might take out the old low. So if that's going to happen, to answer your question about Bitcoin, if this plays out, then I don't think this low on Bitcoin is safe. Here. Because it's from the same exact time period. This is October 2022. This is October 2022. And Bitcoin is following equities. It doesn't follow it perfectly, but it is sympathetic to equities, right? They have days where they diverge, but they largely follow each other. And if there is a catalyst to create a recession, if that actually manifests, then you need to start believing in correlations going to 1 again, because that's what happened back here, right? That's what happened in early 2022. From the top of the market until the bottom of the market, everything was one trade. There were a bunch of people posting about it. The stock market, the bond market, crypto, commodities. Well, not all commodities. That's probably a bad example. But risk assets broadly all followed each other. Traded markets followed each other all the way down to the bottom. And I think that if we get another scenario like that, we're just going to have that same outcome. So if we have a recession, it's kind of an if-then. And if we don't have a recession, then nothing we're talking about here matters and we'll be okay. But I still think the odds heavily favor one. And if that manifests, then I don't see a lot of reason why Bitcoin would defend its lows, particularly now when much of its volume is dictated by the stock market. We have 10 ETFs now trading Bitcoin. And if you look at the volumes on BTC in 2024, there's only volume when the US market is open. I don't know if it stays that way, but if the US market is interrupted in its excitement this year, then Bitcoin probably will be too. Bailey said, would love to hear your takes on China's economy. Yeah, we'll talk about China some. I wanted to talk about it last week, but then we had a long stream. I wanted to talk about it this week, but then it was FOMC and some other things happened. So there are a lot of things going on in China. I did spend about 2 or 3 weeks ago, we spent quite a bit of time talking about how China got to where it is today and how the last 30 years played out, allowing China to ascend to the second largest economy in the world. We spent a lot of time on that. But yes, in the last couple of weeks, there's been more developments. There's been a lot of excitement about China. People think that the People's Bank is starting to stimulate and that China's going to rip. But what I've been telling everyone from my perspective, I don't know, but from my angle, China's going through its own great financial crisis, and it has been for a year. And it's not likely that central bank stimulus will be enough or just be stimulative in general. They're just trying to avoid a debt deflation spiral. They have millions upon millions of people's pensions propped up by property values that are under threat. They have a really serious problem, and they can no longer rely on growing infrastructure and real estate to drive growth because that sector has been wrung dry. They have overcapacity in manufacturing while demand is falling. They can't just plow it back into manufacturing. The overcapacity will just create more deflation. They're already exporting deflation. So they're in a really tough spot. Very tough spot for China. Scrolling back through the chat, see what everybody said. Wow, so many of the homies in here. Really love to see the same names in here every time. David, Luis, Oscar, BT, CB, Charles Carpenter, Intuitive Guy, XP Market. I see BC Backer out there in the chat. What's up, everybody? Brandon Hammond, what's up? Mr. Techno Goody says, hey, Ben Cowan gave you a shout out on NFA show earlier today. I don't know what NFA show is. But he gave me a shout out on his show earlier regarding my value days destroyed indicator. Cool. Yeah, I for those who don't know, there's an indicator I designed for Bitcoin on chain like 2.5 years ago, and it just recently started showing some activity and some people were posting it. So it's pretty cool because I designed a metric at the tail end of the bull market, and it hasn't really gotten to stretch its legs until now. And I've seen some people posting it, and that's pretty cool. The market dumped when Jay Powell said March was too soon. You're right, Brandon Kessler. It did dump yesterday. If you look at the market intraday, when it really started shitting the bed right here, that was when Powell said March was too soon. They got it. They heard him, but but then you go over here and you look at this, and they didn't really seem to hear him that well. They heard him in one ear, but in the other ear they were playing show tunes. Paul says, your integrity to the data is outstanding. Stay true to what you do best. Thank you, Paul. I'm not clever enough to make up stories. All I can do is look at the data and come up with opinions about it. I'm not a good storyteller. I'm not good at coming up with bullshit. Mitch asks, have I looked at Truflation? They use more advanced and real-time methods of collecting price data. They're showing 1.4% year over year. I see people post the Truflation stuff on Twitter, but I haven't actually used their website. Let's go see if we can check them out real quick. This is a group that tries to calculate CPI on their own because we know that the BLS is always screwing with the calculations and stuff. That doesn't seem like the right number. That's aggregated. Where's like the year over year figure? Oh, okay. Maybe I can't see it because. Oh, here we go. U.S. inflation rate, 1.4%. Yep. Cool. Oh, here's the trend. Yeah, so they show inflation drifting down. What are these colors? Food and beverages total, food at home, food away from home. Okay, so this is food, housing, transport. This is a cool site. I haven't really looked at their site before. Healthcare costs have been rising. Yeah. Clothing, apparel's coming down. Yeah. Cool. This is a cool site. I haven't really looked at it too much. 1.4, that sounds in the ballpark, right? Because if you look at the rates of change of 1 month, 3 month, 6 month annualized, year over year, or the trimmed mean or trimmed medians, some of them are higher, but we have rates of change on a 1 and 3 and 6 month basis that are below 1.5%. So for Truflation to show 1.4, kind of matches up with that. Man. Oh, wow. Andy Philpott. Welcome, brother. I know your name from Blockchain Backers stream. I hear him say Andy Philpott's name on Markets in the Morning all the time. Welcome, bro. Good to see you. I see Alessandro there in the chat. So the first cut in the summer, unless unemployment rises too much. What's too much? Are they expecting 4.1%? That's a good question. FOMC, Summary of Economic Projections. Let's go look at the December projections. Nope, I skipped it. It was at the beginning. Here it is. Unemployment rate. So this is what the Fed thinks the data will be like. Here's 2024. Right here. So they think that unemployment might be 4.1 by the end of the year. And they still project only 50 basis points or so. Well, about 75 basis points or so of cuts with unemployment rising. So I think it would have to rise a whole lot more than 4.1% for them to feel pressure to move any more quickly than they already said they were going to do. And what they said they were going to do was about 75 basis points of cuts-ish. You know, it's hard. You can't perfectly judge that. It shows about 80. But if you assume their cuts are roughly 0.25% every time, as they historically tend to be, that's usually the increment, then not cuts, but just moves of the policy rate. Generally speaking, they tend to move the policy rate 0.25% unless they're forced to do something else. And so they showed 3 cuts with unemployment rising another 0.4%. So I think it would have to rise a lot more, Alessandro. If it just ticked up to 3.9 or something, I don't know how much that would affect them. I think it would need to be in context with other data. All right. Keep scrolling the chat. Save the currency or the economy, stuck between a rock and a hard place. Yeah, that is where China is right now. China is stuck between destroying the currency or letting the economy slow bleed. And they don't want to lose the currency because it will have major impacts on their export ability, on the flows into their country, which are already going the wrong direction. They don't want to lose the yuan. And if you look at the yuan, see online. If you look at it, let me get this shit off the screen. It's already quite elevated, right? Like, it's all the way up here. This is like at a 15-year high. It's just hanging out up here. They don't want the yen trading at like 7.5, or yuan, sorry, not the yen. The yuan trading at 7.5 or higher. Right? They're trying to avoid just debasing themselves to hell, and you know, all of the impacts of that. I applaud him, I assume Powell. I applaud Jay Powell for having the cojones to say it. He's normally pretty careful. Perhaps the risk of saying it didn't outweigh the benefit of preparing the market. I assume you probably mean about how March is not likely to be the first cut. You applaud him for saying that that's not probably going to happen. I do too. And what I keep coming back to is their forward guidance. Like, do you guys remember in summer of 2022, I think it was June of 2022, right before the FOMC, like one day before the FOMC, Nick Timiraos of the Wall Street Journal, who is this guy right here who gave us the red line thing, this guy, Nick Timiraos of the Wall Street Journal, he's at all the Fed meetings. He works for Wall Street Journal. He's called the Fed Whisperer. He clearly has an insider at the Fed. He gets a lot of like little scoops and things on that. And in 2022, in like May, June of 2022, a day or two before FOMC, he released a news story that said the Fed is thinking about hiking more than 50 basis points, which is what they did in March. In April, they did 25. In May, they did 50. And then in June, they wanted to jump up to 75 basis point hikes, remember? And they did 4 in a row. Well, right before the first 75, Nick Timiraos had a news story. Let me see if I can find it, actually. It's j.com. Let me see if I can find his news story. Nick Timiraos, WSJ, June 2022. I'm not gonna be able to find it. Okay, the story is he released a leak. It was a famous leak a day before the FOMC that prepared the market for the fact that the Fed was going to hike 75 basis points instead of 50. 50 was what was priced in. And the Fed wanted to avoid surprising the market so much that they were willing to obviously leak to the press that it was actually going to be 75 a day or two in advance and give everyone a chance to get it priced in. And they have gone out of their way every single time to try to navigate the market down to whatever the truth is about where they're going with rates. And it hasn't been surprised since. And almost every single FOMC, the policy rate that we left with was nearly 100% priced in, like 90% or higher. And it's because they go out of their way to tell us that that's what they want to do. And that's why it rings so hollow for me when I see rate cut expectations completely ignoring what the Fed is actually saying. It just doesn't make sense. All roads lead to one last blow off top before recession and bear market. I do think that is a high risk because we have really narrow market participation right now. Participation in the rally. Right, here's Nvidia. This story is as old as time at this point. You guys have heard these stories so much. Microsoft, until the last couple of days, was also leading the charge, but really Nvidia doing most of the work. But then if you look at like small caps, the Russell, it's been coming down, right? The last couple of days have been down while Nvidia has been screaming higher. It hasn't even gotten back to its high from December yet, whereas the S&P is like up at all-time highs. So market leadership is really narrow right now. And that's a late cycle phenomenon. I hate saying that all the time because I feel like a broken record. I told you guys last week, I feel like the boy who cried wolf a little bit. And I feel like parts of my audience are just they're tuning it out a little because the data looks really good. It does. The data looks good. The economy looks strong. Labor hasn't really buckled, though I could point to plenty of places that we have concerns, right? Pieces inside of labor whose rate of change are concerning. I can point at the soft data of what businesses say is going on, which sounds way worse than the recent acceleration in the PMIs, which suggests the economy is doing better. So I can find data that tells a story, but the truth is the economy is strong. Last year, like I said, real GDP was 2.5%. Unemployment is at secular lows. And the economy or the markets are ripping. And the Fed might actually cut interest rates soon. But I still remain reserved in my broad thesis because it's a multi-year sequence. It's a long process that plays out. And we have rarely ever gotten this deep into that process and gotten out of it without a recession. There was only one instance where we even got close, and we only delayed a recession for another 2 years beyond that. That was 1966. And there's already things about this era that don't jive with that, like the rate of change of the labor market, which had already begun reaccelerating in 1966 by this point, but for us, it has continued to slow down, right? That's a chart we've looked at a lot together here on the channel, right here. And so I remain quite reserved about what I think is the outcome. The stock market doesn't really give a shit what I think. And as I see leadership narrowing as we push towards the highs, and we're still watching for the long-term resolution of the 4.236 extension off of prior market crises, we're right here. We're right below it. And when I see us right below it, and I've had this recession thesis that has continued to develop, and I see this really difficult situation this year where the market really needs a whole lot of cuts, and they've been holding out, paying for credit, paying for property, paying for the economy is slowing down in terms of credit. The credit market is slowing down because everyone's hoping for cuts, but they might not get them. The Fed's saying you probably won't get them. The economy is saying there's not a lot of reason to give a lot of cuts. And we're right here as breadth is thinning out, as things like NVIDIA are just irrationally screaming higher. There's no reason for me to abandon my thesis at all. If anything, I just feel more confident about it, and I don't really care what people think about my opinions. You know, like if someone thinks that I'm ridiculous or that I'm sidelined or whatever, it doesn't really affect me. I'm looking at the data. I'm looking at the rates of change of the data, and I see many recessions in the past where we had really strong GDP growth right before it hit. It doesn't mean anything. It's great that it's strong. That's not what I'm saying. What I'm saying is that strong GDP, strong real GDP, does not prohibit a negative outcome either. And so none of that is actually evidence for or against having a recession thesis. And that's another thing that I have conversations with people about a lot. And I'll show you what I'm talking about here. Like, if we just look back in time, this is real GDP on a quarterly annualized basis. And like, look right here. There was a 4.9% real GDP print in the first quarter of a recession in 1981. In 1973, there was a 3.9% real GDP print in the first quarter of recession. In 1957, it was 4%. There's other examples in here of it being pretty strong 2 quarters out from recession, not just right in front of it, but 2 or 3 quarters out. It's not like it has to be like this here, like in 2000, where things are just absolute pancaked, and then we have a recession. That's not really how it works. So I'm glad the economy looks strong, but this is not an input into my bias at all, frankly. And that's just one of the differences in the way that I look at things versus how other people I talk about the economy with, how they look at things. I'm not saying I'm right. I'm not saying they're wrong or that I know something that they don't know. We just have different approaches. I developed this approach myself because I needed answers. I needed to know what the cycle even looked like, right? I had to model the cycle. I started from nothing. And so I developed this perspective about the sequencing of events, the things that play out over time from the beginning to the end of a cycle. It's been a while since some of you guys saw this, right? From the first time they begin tightening until the actual trough in CPI, which tends to be at the end. There's a sequence that's fairly reliable. It's not hard-coded, but it's a general flow through the economy from the more interest rate sensitive and cyclical sectors into the more inertial core pieces of the economy until it finally hits the labor market, and then we spend another year waiting for labor to recover after the recession is over. It's a long process, and I think 2024 is when we really start to see some of the machinations of that, after 2023 was mostly a setup. If we had had a recession bloom in the middle of last year, that would have been anomalous. That would have been weird. That would have been early, and it would have been happening at a sharper rate than we would have seen in the past, outside of COVID. So it would have been unrealistic to expect us in June or July of August last year for the economy to look just obviously weak. We might have started to see signs. There's definitely things that I noticed, certain parts of labor that just looked concerning that we've shared here on the channel. But the whole edifice of the economy hasn't rolled over yet, clearly, right? It's still moving forward. And this process is just very long. And you can see in these eras, I mean, look at this. Look how many days some of these eras are, right? Like 2,000 days is 5.5 years. This is a long fucking process. And it starts with Fed tightening. Fed tightening started in March of 2 years ago. So we're not at a place where we should already know the outcome. We're not at a place where we can definitively state where we're going here. All we can do is say, there's still runway ahead of us, right? Here's our job growth, non-farm payrolls after Fed tightening. Here's all of the other ones going back to 1953. Look how many recessions began in front of where we are now. Here's where we are. Look how many recessions are out in front of us. This is by using Fed tightening as an anchor. On some of our other charts, some of our other looks, we have used the yield curve inversion as an anchor. If we use that as an anchor, then we still have examples of recessions in front of us that started in the next quarter ahead of where we are today. If we use Fed tightening as the anchor, which is useful, I think it's useful to use both of them, then we have 7 or 8 recessions 2 years ahead of us, right? So it's a long process, and it doesn't mean that we're out of the woods. Me having a bearish tilt in the economy doesn't mean stocks have to go down. Like, you need to separate those in your mind. I talk about them separately for a reason, because they are different things. But usually, once one of them manifests a certain outcome, it pulls the market along with it. So until that happens, stocks will do their own thing. Brandon Kessler says, you just clipped your next YouTube video. Return to normal. Market's about to get wet again. You might be right about that. You might be right about that. I already said welcome, Andy Philpott. Welcome, my brother. Luis XRP also joined the channel. Happy Thursday, TXMC. Have your recession indicators changed much? No, they haven't changed a whole lot. Certain things have accelerated. So I think it's pretty clear, it's obvious that we're seeing a slight reacceleration in some of the cyclical parts of the economy, which looked really weak far in advance of Fed tightening. And I think that is worth mentioning, because usually when you start to see the slowdown in some of these cyclical pieces like industrial production, real manufacturing sales, real retail sales, these things tend to start weakening in the Fed tightening process while rates are being risen slowly over time, over the 2-3 years of Fed tightening that we normally get before the recession. But what happened this time is that these things all peaked very early in the process. So they pulled way down. They looked extremely recessionary many months earlier than other things did. And now they're slowly starting to pick up on a rate of change basis. And when you look at them versus the recession comps in the background, the gray lines, when you look at the black lines versus the gray lines, black being today, gray being the average of recessions, they look like they are accelerating away from a recessionary outcome. But part of that is the nuance of this beginning much earlier in the Fed tightening, because the Fed's tightening was in effect a shock. It was a type of shock because the market didn't believe they were actually going to do it. That's why we had one of the biggest bond sell-offs in recorded history in 2022, one of the worst bear markets in bonds ever. It wasn't just because zero interest rates ended. It's because no one believed that they would. And a lot of the economy lurched in that moment. And cyclical things, very interest rate sensitive things, they jumped a bit, right? And they pulled down, jumped the wrong direction. And now they're starting to dig up a little higher. We'll let the data continue to play out. But we are seeing that. However, credit on an average basis, every single one of these credit measures is deeply below the normal average rate of change. And when you put them all together, you can see the credit market is in a bad place. A bad place meaning nothing's happening. Credit has stopped moving. That's not good in an economy driven by consumption, because it puts all of the pressure on the labor market. And since we're talking about labor, it doesn't look that great. Look at the black lines compared to the gray lines and ask yourself if it looks like the labor market is still historically strong. Here's non-farm payrolls. Here is the household employment figure. Here is a weekly wage composite that is produced by going, what is the average amount of hours worked in a week? What is average hourly earnings? Let's multiply those together and come up with a composite worker. That's this line. Then we go down, average manufacturing hours. That's another one I threw in here. This one's really choppy. Actually, we're just going to take this one off because that one's a little bit inconclusive either way. It's just really choppy. Unemployed persons, people saying that they lost their job. We had a fall here, but the acceleration, the rate of acceleration is following the historical trend line. Job losers, people who say they were fired from their job against their wishes. It's hanging around near the baseline, but it's above zero, and it's still close to the historical trend. Part-time for economic reasons. Also, a very volatile series, but the same kind of story as job losers. So we've got the cyclical pieces. Those have started to accelerate. The credit components look very bearish. They don't look good at all. When we look at demand, like people spending money on things, it looks pretty good. And we would expect that because we printed a shitload of money and currently everyone's getting 4-5% deposit rates on cash. So I would expect there to be decent consumption figures. That is what we're seeing. Real PCE on durable goods, total real PCE, PCE on services, real incomes. Those things look okay. Real income looked really bad for a while there. It has started to pick up just a little bit, but compared to the entire distribution of all of the prior eras, it's still on the low end. It's on the low end of real income growth. But labor is following the slowdown formula. And it's indicative here as well. And so I am not ready to declare victory on any of these things in either direction. I can't say that we're having a recession. I can't say that we're digging out of it. I do think it's possible that we're around the time where it could be dated to have begun. I thought that a couple months ago, but some of the softer labor stuff has cooled a little bit, and so I've backed off of that belief. But my overall thesis on a recession hasn't changed, and I think that it's going to take at least half of this year for us to really know, because we still have so many examples ahead of us and the data so far continues to cooperate. The thing we really need to be asking ourselves is, can job growth, oh my God. The thing we need to really be asking ourselves is, can job growth just do this? Because that's what it needs to do. It needs to do that. If it does that, we might be okay. Big Shroom says, I heart you, TXMC. Thank you, bro. I heart you as well. Thanks for all your efforts and honest opinions. Your hard work and clear analysis is appreciated. Thank you, Jules. Thank you very much. Ah, the skeleton key chart. Yeah, that's right. That was this one here. It's just not something that's appropriate to look at all the time. It's really cool for making a point about the sequence of events and how consistent it is. Because if it wasn't consistent, you would just see dots like all over the place, right? They wouldn't be in this clustering here. It would just look like a crazy scatter plot, like someone had rained all over my chart. But it's not what it looks like. It looks like this. Because there's a sequence. Some of them come after each other, like the trough of CPI comes after the peak of CPI. So that makes sense, but they don't all work that way. And the cyclical, more interest rate sensitive things, those tend to turn first. So it's useful to look at, but I haven't pulled it up that often. I get asked about it sometimes by viewers. I haven't pulled it up that often because there's not always a lot to say about it. It's really just to make a point. Checkmate says, is it possible that Bitcoin could be a left translated cycle, meaning new all-time highs by November, after which the bear market across all markets begins? So, that's something I think I've talked about a bit, but I'll riff on it a little bit for you, Checkmate. There's something I think about Bitcoin. So I know that Bitcoin has these really symmetrical cycles that everyone knows and loves so much. They have a certain distance of time between them. There's a certain fractal nature to the bear markets and how they look, and I respect that, but I don't think that it is a prescription for the price. I don't believe that. And the way that I've illustrated this in the past is that I think that Bitcoin's been having these little cycles like this, right? That's probably too many. It was 2011, 13, 17, 20, and now maybe we're coming up for another one here, right? Here's the GFC. Over here. Since this moment, with the exception of COVID, can we just pretend COVID didn't happen for a moment? Because that was an artificial shock, and by many measures, wasn't the end of the business cycle. It was an artificial shock. We kicked the can and we avoided any negative outcomes. We roiled the markets and the economies for years, but we avoided a recession in the traditional sense. So let's just put COVID aside. This was the last real recession. And since this period, the economy broadly has just kind of been doing this, right? The GFC was a this moment for the economy. The economy was going like that, and GFC, and then it kind of did like one of these, right? I'm simplifying for the purpose of conversation here. So if this was the last dip here, if we are actually going to have another recession here, then it's hard for me to accept that Bitcoin's just going to continue its cycles. I feel like it's more likely that it hits this and that it does one of these, and that it breaks cycle symmetry. Because it is a smaller asset than the US economy, than the global economy. And oh, by the way, it's not just the US that is at risk of having a recession. We spend a lot of time focused on the Fed and the US economy, and rightfully so. I'm American. It's the biggest economy. The Fed's the most important central bank. But it's not the only one. And there's trouble all over the place. And if we're going to have a recession on a global scale, let alone just a US one, then it's almost impossible for me to see a scenario where Bitcoin just goes, oh yay, just like shoots up through the middle of all of that. I think it's more likely that Bitcoin is currently putting in the retracement of the conclusion of a 15-year cycle that we haven't seen the end of. I think it's possible that when we get to the end, Bitcoin's cycles will look like this, right? Loosely drawn here. That it'll look something like that, right? Or we will have taken out a couple of cycle lows behind us, and then it recovers, and then maybe it starts again. Maybe it starts a new kind of thing. And this is the pattern that we didn't know we were still completing, right? Because everyone just sees this part. Now, there's a lot of people that laugh at me when I point this out, but I have a lot of research behind having this opinion. I'm trying to simplify it into a framework that I can explain with squiggles. And if we've got this price, I mean, look at it. Everyone thinks it's just going to go like that forever. What if it's one of these? Like it could be something else where we take out cyclical lows because we have an actual fucking recession and risk assets get their asses kicked in those. And then we recover. It's possible. There is no reason why it shouldn't be possible. I think it's likely. I think it's more likely than it's ever been before. None of the prior cycles had this setup. So whenever people tell me, oh, well, people said it would be different this time back here, and they said it would be different this time back here, and look what Bitcoin did. Yeah, well, none of these periods had the economic setup that we have been talking about for the last year on this channel. None of them. There is no comparison. So the interesting thing about it is people laugh and say, oh, this time is different for Bitcoin. I thought it was never different. Well, the thing is, this time is probably not different for the economy. The economy very consistently has these sequences lead to a specific outcome. Once, 1966, did it not. Every other instance, all of these, it led to a recession, especially once we got this deep into the process, right? Bitcoin has never seen one of those. It has never had an opportunity to produce a history in that environment, a true recession. So if the economy is going to play out a sequence that it has been doing for over 100 years, then this time is not different for the economy. But that means that it is different for Bitcoin. Do you understand why that is? Because this was the last recession, and here is where Bitcoin started. So if we have another one of these, then yes, it is different. It's about as simple as I can make it for the naysayers. Not that you are a naysayer, checkmate. I'm not really yelling at you. I'm just ranting and kind of responding to people that I deal with on Twitter a lot with these conversations. Matt Hebert, what's up, bro? Good to see you. I know your name from Twitter. Good to see you. All right. So those are my thoughts today. I wanted to talk about more, but dang, guys, we've been going for 90 minutes. Am I going to have to start doing more than one stream a week? Like, I feel like we run out of things. We run out of time more than I run out of things to talk about. What I don't want is to commit to doing a stream all the time and not always having something to talk about. That's what I don't want, because then it starts to feel like work. It loses its signal. I start searching for things to talk about, and that's not where I want to get to. That's what made it hard for me to make pre-recorded videos before in 21 and 22. And the reason I stopped is because I felt pressure to always be coming up with something to talk about. And a lot of times I just struggle to do that, you know? A lot of times I'm just in wait and see mode. Live streams are a little different because it's more interactive. But I'm starting to wonder if maybe we need to do like 2 a week or something. I really don't know. I'm thinking about it out loud. But this is now the second week in a row where I've had a bunch of things open, a bunch of tabs open on my browser. Here, I got all these tabs open. I haven't gotten to any of them because we spent the whole time talking about the Fed and this cycle because there's a lot to say. So. B Skeet says topic oriented. Yeah, maybe that's the way to do it. Maybe there needs to be like a Bitcoin and markets stream and then like an econ and news stream or something. You know, I'm not real sure. I don't have an answer. I'm just kind of thinking out loud and seeing, you know, how you guys give feedback to me thinking these things. So that's kind of where I'm at with it. But we had a lot more to talk about. We'll save some of those things. I've talked a bit about it on Twitter, so you can read my feed if you kind of want to get the high-level notes of what I've been thinking about with real estate and things like that. But we'll wrap this up. I don't want to keep everyone too long. We'll take a break, and then at the top of the hour, we'll do a private stream. Members only, green names only. So it's 12:35 my time right now. We will do a stream at 1 p.m. Private stream, like I said. If you are, I'll go ahead and book it right now, actually, so you can see it on your timeline. Let me go ahead and save that for you guys. So here in a minute, it'll show up on your feed. And yeah, you'll see February 1st, Alpha Beta Soup, members only stream at 1 p.m. So it starts in 25 minutes. Feel free to bring your questions. I won't have an agenda. I won't talk for an hour and a half straight. It'll just be more back and forth. And yeah, we'll take it from there. Make sure you've hit the like button. Make sure you are subscribed to my channel. If you are wanting to get on these streams when they start or find out when I schedule them, make sure you enable notifications. Click that little bell icon next to the subscribe button on YouTube. You'll find out when I post new scheduled streams. And that's where we will wrap things up this week. Wanted to talk about China, wanted to talk about commercial real estate, but we'll save some of those. Those things we can continue to talk about. We don't have to talk about them right this second, but they will be ongoing themes in 2024. I really appreciate all of you who came out here. Thanks to everyone who gifted memberships today. David and Eric, thanks for gifting. Luis, Sandy Philpott, XP Market, H and Abeja, welcome new supporters of the channel, new and returning supporters of the channel. You guys are appreciated, and I will see all of you in just under half an hour. So until the next time, take care of yourselves, friends. Take care of each other, and we will chat before too long. Cheers, everyone.